Hi, Mohnish. Will Sparks is my name, from a company called Quilter, and I manage investments myself. My question is kind of out of the investment sphere. I mean, you're a big subscriber in the wisdom of Charlie Munger and Warren Buffett. What are the daily nuggets that you tell yourself every day that you've learned from the two of them?
Yeah, so I think that there are two or three, I think, very big lessons to take away from them. So one of the biggest lessons, the most important trait to be a good investor is patience, and extreme patience, which is difficult for humans. So the interesting thing about equity markets is, if we look at our phones or look at screens, we've got flashing lights, red and green, and things are changing by the second and such. Real change in businesses takes years and sometimes decades. And changes in market prices of equities happens in seconds. And so the two are, in many ways, disconnected from each other. And so I think Fidelity, the big brokerage house in the US, in the mutual fund shop, they had done a study. So they have a lot of clients who open accounts with them and then manage those accounts themselves. They buy and sell stocks themselves. So they studied all these accounts that people were running on their own to try to figure out which of their clients were really good investors. And so they found that there were a set of accounts which was sitting like in the top 10% performance of all the accounts. And the overwhelming number of the people who owned those accounts, they later found fell into one of two categories. Either they were dead, which means that they had the account and then they were no longer, there was no pulse, okay? And people forgot that this account was there and it just kept going, doing really well. Or they had forgotten they had the account. Okay, so the two best performing criteria was either you were dead or you'd forgotten, okay? And so generally speaking, activity in investing is likely to hurt you more than help you.